Chinese tech shares were headed for record lows in Hong Kong as Didi Global Inc. S announcement to start as delisting and rising scrutiny on mainland firms traded their dealt a further blow to already soured sentiment on the sector. The Hang Seng Tech Index, which tracks mostly big Chinese technology giants traded in Hong Kong, dropped as much as 2.6% to hit its lowest level since the gauge was launched in July last year. Members of the index have seen about $1.5 trillion of combined market value evaporate since a February peak. Ride-hailing giant Didi said Thursday it has begun preparations to withdraw from US stock exchanges and will start work on a Hong Kong share sale, yielding to demands from Beijing that had opposed its American listing. The news came after US regulators announced a final plan for putting in place a new law mandating foreign companies open their books to American scrutiny or risk being kicked off its exchanges within 3 years. American investors will be keen on selling the aids if they are forced to delist from the US, which will add pressure on their share prices in Hong Kong, said Gary Cheng, an analyst at Guosen Securities Inc. Financial Holdings Colorado. Hang Seng Tech Index falls to lowest since inception in 2020. Chinese tech companies have already been grappling with Beijing's tightened regulations on areas ranging from digital finance and data security to online games and overseas listings. Separately, a Securities and Exchange Commission in July vowed to require more information for Chinese firms seeking listings in the country. Didi is aiming to file for the Hong Kong listing around March, people with knowledge of the matter said. A delisting from the US stock market could raise the Chinese firm's cost of capital, according to a Bank of America report last month. There are more than 270 Chinese aids traded in the US with a combined market capitalization of $1.8 trillion, and over 150 of them do not qualify to list in Hong Kong, the report said. Generally, Hong Kong equities trade at lower multiples than their US peers, said Bloomberg intelligence analyst Marvin Chen. In the current environment, definitely their valuation expectations will be reset if they seek relisting in Hong Kong, he added. NetEase Inc., Bilibili Inc., and G.com Inc., which all have American depository receipts, were among the top losers in the Hang Seng Tech Index on Friday, each losing more than 7.3%. It declined further. The Nasdaq Gold and Dragon China Index has dropped overnight to the lowest in almost 19 months in the US. The Hong Kong gauge has lost about 45% since a February peak, with declines accelerating in recent weeks after disappointing earnings season and a report that China plans to ban companies from going public on foreign stock markets to variable interest rates. The continued sell-off this week came after big international financial institutions increased their calls for bargain hunting last month. Goldman Sachs upgraded offshore Chinese equities to overweight from market weight, while BlackRock Inc. has had more neutral positions on China, up from underweight. At block test Y.